Good morning. I'm Daniel Smith. I'm President and CEO of Cooperative Network. Thank you for joining us today. Cooperative Network serves over 250 cooperatives from 12 different business sectors in Wisconsin and Minnesota with government affairs, education, advocacy, and professional development. We are definitely pleased today to have with us Dr. Mark Stephenson from the University of Wisconsin to talk about what's next for the ag economy. The agriculture economy is so important to all of our cooperatives, regardless of what sector or state they are in. And it is very difficult during this time, especially because of the COVID-19 situation, which has really impacted every sector that we serve, every sector of our economy. Agriculture, of course, is no different. From high COVID infection rates, shutting down packing plants, to shifting overnight from food service to retail on top of those already depressed prices that we had dealt with for the last 5 years. Farmers and the rural businesses they rely on have really been put through the ringer. Dr. Mark Stephenson is the Director of Dairy Policy at the University of Wisconsin-Madison. He will give our Cooperative Network members today an overview of the current agricultural market conditions, and he will discuss the pandemic's impact on supply chain and what that means for our economy as a whole. Dr. Stephenson conducts and coordinates research and outreach activities related to the dairy industry. He is involved in applied research at the farm level, including the milk assembly costs, processing costs and efficiencies, new processing technology, and new dairy ingredients. He is also active in sector-level performance, including dairy policy and milk price forecasting. It is an honor and a privilege for Cooperative Network to have Dr. Stephenson with us today. Thank you, Mark, and welcome.
Well, you're very welcome, Dan. I'm happy to be here. And I think this is really a very timely thing to be talking about. Actually, this afternoon, I will be working on conducting one of several focus groups online that with members of the dairy supply chain all the way from farms on through retail sector. And part of what we wanted to do there is to understand what the impact of this COVID has been on all of these segments, but it's also to understand what they've done to try to accommodate it and maybe how we can anticipate we might want to be changing a system to be more resilient in the future. So with that, I'd like to share my screen and we could start looking at some of the slides that I had for you that I hope will outline this. So a question that comes up occasionally is, are we really on the backside of this COVID? Clearly, we're getting some different signals. The administration in Washington is telling us one thing. Some of the administration team is telling us something altogether different. But here's what we do know. There have been about 18 million cases of COVID worldwide and about 700,000 deaths so far. Clearly, this is not over. We have some countries that are really spiking, including the United States. We continue to be on a growth path here. We've had not quite, but approaching 5 million cases of COVID in the United States and kind of a grim milestone of about 155,000 deaths so far. In Wisconsin, we've had about 55,000 cases already, and we're approaching 1,000 deaths in the state. So none of the United States has escaped this. We've had areas that have been hot spots and areas that have been a little less hot, but nevertheless, this has been a pretty substantial pandemic. We've certainly correctly called it a pandemic. So what do we know? This is Wisconsin's cases over time. You'll notice here that we were pretty much inactive until we got into March. And then cases did begin to increase. They plateaued, increased, plateaued, increased, actually declined a little bit. And then as we began to open up our economy and people started to move around, you can see we've increased quite a bit. We're at a plateau again now, but this is a good reason, I think, why the state has decided to step up some of the means of dealing with this, such as mandatory mask wearing in the state, that we've really had cases on the increase. In terms of deaths over time, they have declined a bit for us, but they are up over the last little bit as our cases have increased. I didn't show it on here, but actually the rate of death, the number of confirmed deaths per cases has been declining over this time period, however, as our medical community has become better adapted at being able to manage people. So that's one of the good news stories. But I think the bottom line on all of this is just to say, we're not done with this. This is very much an active pandemic. We're not even on the backside and anticipating victory. The only thing that we've got, I think, are some of our relatively good news stories of development of vaccines and trials right now, and that's something that we're going to be looking at in the near future. So I thought I'd give you an idea about what the evolution of milk prices has been. I'm showing two things in here. These lines maybe aren't as bright of colors as they could have been, but the red line, the dark red line, are class 3 prices, and the black line on here are class 4 prices. This is for the May futures contract at different points in time. So back in January, we were feeling relatively good about where the dairy economy was headed. After 5 painful years, we were finally having a better year, improved prices in 2019. And we expected those prices, the forecast at the time of January or December 2019, were that our prices were continued to improve through 2020. But then we began to hear about this coronavirus in China in early January, and the first known case in the US showed up toward the end of January. As you can see, countries like South Korea became fully involved, and Italy was just overrun. We had our first death from coronavirus in the US by the end of February, and the opinions about prices began to deteriorate. That happened pretty much all the way through this May futures contract. And you'll notice that by the time we get down toward the end of March, early part of April, we had most states that had issued stay-at-home orders. And that stay-at-home directive was one that had a huge impact on our dairy markets. I can't say that all of this decline in price leading up to that was a result of people anticipating a stay-at-home, but it was just a recognition that as these other countries were becoming more and more involved with COVID, our export opportunities began to slow down as ships were trapped in ports and other things that were not letting us get product out, and to other folks. And then when we issued the safer at home order, the dairy world just turned upside down. Here's what safer at home did. This is looking at the same dollar sales for the same week a year earlier. And this is at the retail store. Of course, as soon as we abandoned schools, we didn't have institutional sales of dairy products. And when we couldn't go out to eat, we didn't have out-of-home eating of dairy products. We were eating at home. And you'll notice here in the middle part of March that we had this big spike in all food categories at retail. And the red line that I'm showing you are the dollar sales compared to the same month a year earlier. So in other words, comparing mid-March of 2020 with mid-March of 2019, that our dairy sales were 60% higher than they had been a year earlier. That was a huge spike. Well, everybody's at home, filling up our pantry, getting ready to buckle down. And of course, we anticipated that those sales would decline after we filled our refrigerators and pantries up, but they've actually held up higher than they did before. Half of dairy products are consumed historically, typically, recently, out of the home. So in restaurants, food service of other sorts. When we weren't consuming them in restaurants than we were staying home fixing our own meals. And dairy has continued to be pretty much a superstar at retail. In fact, if you look at all the different segments of the grocery store, from the deli, which is this bottom line down here, they've actually had less sales. People are not buying deli items as much as they did a year earlier. Bakery sales are kind of neutral, and I'm told that a lot of the bakery sales are suffering partly because people are actually baking bread and other things at home and enjoying that as an activity as well as the product that they're making, but also because we used to run out to the bakeries at retail and buy a sheet pan of baked goods, you know, like a cake to take into the office for a celebration, and we aren't doing that anymore. So those sales have really been pretty flat too. But when you look at other products or departments, this top line on here is meat. And I should mention that this is value too, so sales growth. So this is both price and volume. Dairy is not up much in price. Its volume is certainly up, but it's been like the second most active of all the departments at retail. So dairy has done really well, and it continues to be up about 15% in year-earlier sales. So safer at home has been good for retail, and dairy has done relatively well there. But what were the action events as our prices began to collapse? Well, one of the first things were that this reorganization of not producing products for restaurant sector or institutional sector and making them more for the retail sales meant that we had to shuffle things behind the scenes. And while retail sales have been good, our total sales of dairy has been down a little bit. Not a lot, but a little bit. And farmers were asked to reduce milk production. The estimates early on were that we might need to reduce milk production by as much as 10%. Well, that never happened, and I don't think we needed it. But we did have cooperatives that implemented base excess plans to reduce milk production from their members, and even direct ship milk plants were telling their farmers that I can't take all your milk. So I will only take 95% of what you've been shipping or something like that. Those action events were put into place. I want to look at just a couple things here. This is the number of dairy cows in the United States. And you'll notice the red line on this graph is this year, 2020. And by the time we got those reduce your milk production, you can see that one way in which we were reducing milk production was with the number of dairy cows. So farmers actually did begin to cull dairy cows. There was a little bit of issue and problems with livestock slaughter and auction houses that were closed periodically, and we didn't have a good channel for that for a few weeks, but that got cleared up, and we've actually reduced the number of dairy cows in the U.S. herd. So partly our loss has been through dairy cows. I'm not showing it now, but as prices have rebounded, we begin to see that the number of cows going to slaughter is less. So I expect that the number of dairy cows is going to plateau and maybe even begin to creep back up again. We'll have to watch and see how that evolves. The other thing that farmers could do is to think about not pushing cows so hard. So one thing we could do is to reduce the concentrate in the ration of dairy cows. And you can see that we actually did that. Again, the red line is showing you 2020 values for milk per cow per day. We'd started out this year strong, big increase. And then by the time we get to March, April, May, that was clearly part of the strategy that dairy farmers employed. Let's not push cows as hard on milk productivity, but as prices began to rebound, you can see that we're beginning to move that back out again as of our June milk production report. I wouldn't be at all surprised that by the time we get to July and these fresh animals that are coming into the herd and the middle lactation and even end of lactation animals are going to be getting a little more concentrated feed, and probably milk per cow is going to be coming back up as well. When you take a look at the total milk production change, here's what we saw. Producers had begun to respond here at the end of 2019 because prices were considerably better than they had been. And milk production was starting to come on strong. This is a percent change in milk production from year earlier levels. We did get over 2.5% increase in milk by the time we got into early part of spring here in the US. But again, with those base excess plans and other restrictions on milk production due to COVID, our production increase just collapsed to actually negative values. They've rebounded just a little bit, but we're basically in here at somewhere around a 0.5% increase. And if we can keep this milk production increase from getting much above 1% this year, I think that our milk prices stand a good chance of staying relatively strong. If they get too high, if we begin producing too much milk and it has no place to go, then we're going to have a collapse in prices again. So reducing milk production was one thing. Another thing that happened was that, excuse me, cheese prices really tumbled during that stay-at-home time period and when exports began to fail. And when cheese prices tumbled, that stimulated some rapid export sales. Here's a graph that shows that. Our cheese prices had been up around $1.80 a pound, and they collapsed to $1 a pound by the time we got toward the end of March, or middle part of April. $1 a pound. We hadn't seen $1 a pound since 2004. I think it was in November of that year. Had to go back quite a long time to find that kind of price. So that was a big discount relative to what the rest of the world was selling cheese for. Their price sales were maybe around $1.40, something like that at the time, US. So at $1 a pound, we had a bunch of people that stepped in and bought cheese from us overseas. And that is actually being shipped right now. This will show up in our next export report. But we do have knowledge of activity of cheese sales even before they get reported as being shipped out of the country. So export cheese sales helped to begin to tighten up that market along with the reduction in milk production. And then, of course, we had federal help through the CARES Act. Part of the CARES Act was the CFAP. And CFAP identified $19 billion for agriculture. There were $2.9 billion in direct payments for dairy, and there was about $3 billion for food box program, which included dairy products. And as the government began to buy quite a lot of dairy product, then we found that tightened up the demand for cheese product as well. We've also had an increase for the food and nutrition programs, SNAP programs, and there have been such things as a Paycheck Protection Loan Program directly available. And finally, states began to reopen restaurants. So all of those things stimulated our domestic demand for cheese as well. What happened? Well, we went from that $1 a pound that we had over here to the unheard of price of $3 a pound. $3 a pound. Fresh cheese couldn't be found. And we had quite a lot of cheese in inventory. Our inventory values had grown, but we're pulling them down, and the fresh cheese just wasn't available. Now, those prices have declined some since that time period, and I'm not surprised, but that just shows you how rapidly we went from don't know what to do with the product to, oh my gosh, where can we get some more? This has also stimulated quite an evolution of farm milk prices. These are showing you, this graphic is showing you in red line class 4 prices, in the blue line class 3 prices, and in the green line the US all milk price. You can see the impact down here on all of those prices as they collapsed. But then since that time period of cheese prices increasing dramatically, that's had a real impact on the class 3 milk price here in blue. And we're going to see an even higher milk price here in the announcement of prices tomorrow, something up around $24 per hundredweight. So these are prices we haven't seen since 2014. But you'll also notice that our class 4 prices are hanging way down here. Butter and powder prices have been tepid, and the class 4 prices have been much, much lower than class 3. This big spread has also been kind of a problem for us that I'll talk about here in just a minute. But I want you to recognize how rapidly these prices have rebounded and what a difference there is between class 3 and class 4 manufacturing milk prices. This has given us massively negative PPDs. The producer price differential on your Milkcheck is really kind of an accounting feature. So what do I mean by that? Well, we take in values across the marketplace for all classes of milk. Class 1 is fluid milk. Class 2 are what we characteristically call soft products. That means products like cream cheese and sour cream and cottage cheese, those type of things, yogurt, ice cream. Class 3 are hard cheeses, and class 4 are milk powders and butter. And you'll notice that in times in the past when we've had rapidly increasing prices, that our time lag between when class 1 is priced and when class 3 is priced can sometimes mean that class 3 prices are actually higher than class 1 prices. Under that circumstance, we get a negative PPD because we're paying out an average price over all those classes that we call the uniform price, or sometimes called the blend price. But we pay out on the basis of component values in class 3. So if we pay out more in component values in class 3 than we've collected across this weighted average uniform price, then our PPD is negative. Take a look sometime at the Market Administrator's Bulletin. If you look at the uniform price and the class 3 price and just subtract the class 3 price from the uniform price, it is exactly equal to the PPD. So again, PPD is kind of an accounting. It's a way of spending what normally is a positive value out across the pool just to make the pools balance. But if we've paid out too much in components, then that PPD calculation is going to be negative. If you look down here at the June values, we knew that this PPD was going to be negative. If nobody depooled in order 30, then the expected PPD would have been about a negative $1.30. Now, what that effectively means is that rather than a cheese plant getting to take a draw like they did up here in May of 13 cents from the pool to be able to pay that to their farmers, they would have to be contributing an extra $1.30 to the pool in order for class 1 plants, among others, to be able to pay their dairy farmers. So there is a relief valve in federal milk marketing orders that says that any manufacturing plant is not obligated to be involved in the pool. They can depool. And under these circumstances, cheese plants would look at that and say, sure, why would I want to pay money to producers, that are shipping milk to a class 1 plant? I will depool. Well, when plants are depooled, that effectively means that they can pay anything that they want to for the milk coming into their plant. They could pay the class 3 price, but they don't have to now because they're not regulated. So the class 3 price would have been $21. That would have been pay all of my money to my producers and not to producers that may be shipping to other plants. But you can also recognize that a depooled cheese plant might say, well, wait a minute, I don't have to pay $21 to producers. What if I paid them something like $20? That would be what other producers are receiving in the way of milk checks. so they wouldn't feel necessarily like they've been deprived of funds. But, you know, I would still be able to keep $1 or $2 of that milk money for myself and use it in the plant. If we had 100% of cheese plants that depooled under here in the federal upper Midwest federal milk marketing order, the PPD could have been as big as a -$8. So that's with 100% depooling. This is with no depooling over here at -$1.30. What we actually had was something in between these two things. So not all class 3 milk depooled. And even the plants that did depool, when I took a look at milk checks that farmers received, you know, they kind of split the baby, if you will, that maybe cheese plants kept about half of those additional proceeds and about the extra half they paid to their dairy producers. So in some sense, I think that's fair. I will say that cheese plants and most other dairy plants have had a really tough time during COVID. The reason is that during that collapse that we had in prices down to $1 a pound cheese, there was milk available everywhere and a little bit of milk dumping that occurred. Plants took milk into their operation and made cheese when they had no customer for that cheese. They were concerned about dairy farmers and were willing to take a gamble that they would be able to sell that product later. And they have been able to do that. So that turned out to be a good thing, but at the time they didn't know it. The other thing, of course, is that many of the workers in cheese plants have been receiving higher salaries, hazard pay, if you will, for the COVID time period. And there's been no price relief for them under a federal milk marketing order. Those make allowances to plants have not been changed. So I think that we can expect that we're going to have negative PPDs here for the next few months. They could be big. I suspect what we're going to see is something more in the middle here, like a -$2 to $3 for a few months period of time. This first month was mostly due to the rapidly increasing class 3 price, but we have one other feature of PPDs being negative that we've never had before. In the last farm bill, Congress changed the way class 1 milk is priced. It used to be priced based on the higher of class 3 or class 4 plus a differential. And now it's based on the average of class 3 and class 4 plus 74 cents plus the differential. So if you do take a look at that big difference that we had between class 3 and class 4 over here, in fact, it's going to be, you know, something like $11 here in July. The PPD is going to be negative, not because prices are increasing so much as it is that the spread between 3 and 4 is large. So negative PPDs are going to be a feature. As I mentioned, rapidly rising and big spread, considerable depooling. This, I think, has exposed some problems in federal milk marketing orders and is likely to be a point of discussion over the next few years. I think we'll be looking at hearings in federal milk marketing orders, not all because of negative PPDs, but because of things like the make allowance, the way we discover prices, the fact that there just isn't as much money in federal orders as there used to be, and what are or what can we do about it. So we'll have to look at that. But all in all, as bad as things have been for us, it's been better than we thought it was going to be. The blue portion of these bars is showing you the US all milk price. And in 2020, I've got the projection of the US all milk price of being a little better than 16.5 or 17.5, 1760, something like that. But we've also had a few other things that have gone on. So for those of you who have signed up for the Dairy Margin Coverage Program, the orange at the 950 level, the orange part is showing you what the net benefit for DMC would be. This is even after paying the 15 cents on the first 5 million pounds of historic production. So we're looking at farms who signed up at that 950 level, receiving about an average of 66 cents per hundredweight across all milk in 2020. Considerable. And then, of course, we've had the CFAP payments that have come directly to farms based on their first quarter's milk production. Over the year, that's going to average about $1.55. That's a substantial amount too. So if you take a look at the milk income here, just from these three things, the marketplace, the DMAP pay, or the DMC payments, and the CFAP payments, we're going to be approaching a $20 milk price. And if you protected some milk, maybe at the end of 2019 with something like dairy RP, there were opportunities available. Maybe you've got another 40 or 50 cents a hundredweight on top of this, and you will be breaking that $20 level. Best milk price we've seen in 6 years. So you have to go back to 2014 to find a better milk price than this. We've also had some change happening in the Milkcheck. This is showing you the component value share in your milk checks. So we get paid obviously based on butterfat value, protein value, and other solids. And as our cheese price has increased, so too has the protein value of our milk check increased. It wasn't very long ago, just back here in 2018 and even 2019, when protein made up about 1/3 the value of a milk check, and butterfat was making up the other 2/3, and other solids, 5-6% down here. That has flipped completely now. We've got 2/3 of the value of our milk check coming from protein and only about 1/3 from butterfat. Farms have been breeding and managing for components here for some time. Many people would tell you, these things are locked together. You can't get one without the other, but that's not true. We've had farms that have been increasing butterfat percentage or component delivery faster than they have protein. But this is a different price signal. This says we want protein more than butterfat. I'm not sure I'd start a whole breeding program based on that, because it may be that 6 months from now this turns around again. But nevertheless, it is what we see right now. So what does the future look like? I'm skeptical about COVID's impact on things like school reopenings. And that means everything, from elementary schools on through post-secondary schools. I think that it's going to be difficult for us to not have outbreaks in these places where we've got our children getting together in large numbers. It's going to be difficult for them not to be close and for the virus to not spread. So I think that, we're going to have to see, but I'd be surprised if we make it to Thanksgiving before we begin to see some of our schools saying we've got to start to go back to remote education. It's not the most desirable thing. Clearly, we want to have personal in-school teaching, but I'm not sure we're going to be able to do it. Well, this has implications for the way that we're eating dairy products. Will we have less food at home and more through institutional if schools successfully reopen? By the way, the school program and milk in schools represents somewhere between 6 and 8% of fluid milk sales. So it's substantial. And if schools are opening either fully or partially, then we'll have some more milk sales through schools, but probably less at home. I don't think we're going to be able to declare victory on the pandemic until we achieve herd immunity. And, herd immunity that we keep talking about is when maybe 60-70% of the population has achieved immunity to the disease. Now that can happen because we've all been exposed to it, we've had it and survived it, and we have immunity. But I don't think that's going to be the case. I think it's going to be because we have a successful vaccine that's been widely administered. And I emphasize that because there are plenty of folks that are just saying, I'm not going to be the first one to sign up for getting my shot. But when it's widely administered and if it's successful, then we can achieve this level of herd immunity and get back to a more normal lifestyle. Our demand has remained surprisingly resilient, even if it's been somewhat different. We've lost some total demand, but even export sales have picked up. The last month, May, that we had data for, sales were up something like 18% over last year's time period. And, it's not as good as it has been at the peaks, but the export sales have been okay. And domestic demand, even though we're not going out to restaurants as much, and we haven't opened schools yet, it's been surprisingly resilient. Consumers are buying dairy products, including beverage milk and cheese and even butter at retail, and they're using it at home. So it's been different channels, but it's there. One thing that I think the dairy industry needs to do is to meet the consumer where they are. We scrambled to get enough volume of product, not just fluid milk, but packaged cheese and everything else in consumer packages to retail where and when they need it. But, when I'm saying this, we need to meet consumers where they are. I think that we're having to try to get consumers comfortable with using dairy products in their cooking at home. And, I've read plenty about consumers who are saying, well, they've been working to try to perfect about 4 or 5 recipes, but they're starting to get bored of that now. And they're wanting some variety. So I think perhaps the one thing we need to do is to begin to teach them how to prepare some different products at home that are still dairy intensive and utilizing dairy products. So let's get out there and meet consumers and help them to enjoy cheese and dairy products at home. But even when we've managed to achieve herd immunity and we've declared victory on our pandemic, I think we need to be prepared for a long economic recovery. Here is Restaurant Performance Index. Now, this is a survey of restaurants where you're asking them for real data, not just how do you feel about things, but hard data. How many customers do you have across your threshold? What kind of meals are they buying? The high-end meals on your menu or the lower end meals? And anything that shows this value above 100 is supposed to be expansionary, that restaurants are doing a little more than they did the year before. Anything below 100 is contractionary. Look at the drop that we had when restaurants have effectively closed. It is way lower than the plunge that we had during the recession of 2008 and 9. We thought this was an incredible plunge. This is even worse. And I worry about restaurant performance even after we get out, because we're probably going to have less concentration in restaurants. And it's my understanding that almost 25% of restaurants have actually failed already. And I'm not sure how many more are going to make it to reopening, but still, restaurant performance has not been good. If you take a look at consumer confidence, however, in the total economy, the general economy, it has dropped pretty dramatically over here, but in stark difference to restaurants' performance, not nearly as bad as it was during the recession of 2008 and 9. This is people telling consumers, or consumers, telling the pollsters that this was horrible. Widespread recession and people out of homes and not able to spend money on all kinds of things. This is different. Many people have continued to work right through this recession, but it tends to be certain segments of the economy, like the restaurant segment, the hospitality segment, like travel segment. Those have collapsed and have been really bad, but it's not the entire economy so far. On the other hand, what I'm showing here is a change in the gross domestic product. This is a measure of the goods and services that are produced and sold in the country. And this goes all the way back to 1947. And if you'll notice here, we've got ups and downs all the way across this time period. Zero is supposed to be, relatively no growth at all compared to the previous time segment, but our growth is generally in the 2 to 3% range. But when it's negative for 2 consecutive quarters, these gray bars are showing you a recession. And you'll notice that we've had quite a few recessions since 1947. And if you go all the way back to 1854, I think it is, we've actually had 33 recessions. But look at the plunge over here in our gross domestic product. This is down more than 30%. You can see the beginnings of a gray column over here that is showing you actually we are in recession right now, technically speaking. We can't call this depression yet. That's kind of an not ill-conceived, an ill-defined measure of economic performance, but it would generally have to be bad for many, many years. The Great Depression that we had was a 10-year time period of mostly negative growth. So we aren't prepared to call this depression, but we are in deep recession right now. And it's going to take quite a while, I think, for our economy to recover from this. I don't believe we're actually feeling this too much yet. Some individuals who are out of work are absolutely feeling it. But in general, I don't think the other shoe is really fully dropped. So just in summary, I think that we've had a better than expected year for dairy. It looked horrible by the time we were into April, March and April, but it's had an unbelievable come around so far. We need to make sure that we keep the consumer in mind and keep the consumer interested in dairy products at home. So we've got to, teach them, think about recipes, think about products, think about an easy way to get things into the dairy home. I was interested to see that we talk about yogurt sales actually being down and cereal sales being up. And I think part of that was just a direct swap that some consumers are just saying, well, I'll have a bowl of cereal as long as I'm sitting here at home, rather than a yogurt to eat quickly and on the go for my commute into work. But when I've spoken with some of the retail stores, they're telling me that the actual volume of yogurt in total has not declined by so much, but the package size is different. Instead of buying single serve tubs of yogurt, those are down. Consumers are actually buying the larger tubs of yogurt and serving multiple meals out of that. Our dairy chain has done an excellent job, I would say, of reconfiguring, of getting milk from a barrel cheese plant to a fluid plant, for example, and in getting cheese cut and processed into consumer-sized packages. But it could be more resilient for the future. There are some things that I think pieces of the dairy chain are going to have learned from COVID. It remains to be seen if they become implemented and make us more resilient for, big demand hits going forward. I'm not convinced, but I think that the worst might be behind us. But I will say that I'm telling you that, and I want to have all kinds of opportunities to backtrack from that in the future, because we really don't have a playbook for pandemics and major recessions. I think that the dairy industry has been through a tough sled here. We do have customers, and if we can keep some of our export sales up and going, we may be able to sustain prices. One thing we don't want to do is to have a big onslaught of a lot of milk production. That's not going to be good for prices here in the next year or two, but we'll have to watch. I would just suggest to folks, be cautious with investments. Don't get overextended. This is not a time, to really be thinking about that so much. This is a time to make sure that you've got working capital available on the farm, and your banker may be your best friend yet for a little period of time while we pay back some of the open accounts and pay down some of the loans. And, if you had some bad experience with risk management, don't give that up. We're still going to find some opportunities for risk management that look good. The sign up this fall here in October for the dairy margin coverage, boy, don't even think about it. Just go in and sign up for the 950 level. It is a good buy. Even though we aren't projecting many payments in the year ahead, we weren't projecting any payments in the year ahead at the end of 2019, and we ended up with some pretty big ones. So 15 cents a hundredweight is cheap. Go ahead and do that, but then look for other opportunities with products like LGM Dairy or Dairy RP. And with that, I'm done with the presentation that I wanted to have, but I would, just be happy to answer some questions if there are any. I don't see any in the Q&A or the chat, but if you want to enter some, by all means do that, and I try to field them. Or Dan, if you had a question, cue it up.
Wanted to ask you, Mark, about, we've heard some farmers have, locked in milk pretty early in the COVID situation at a pretty low price. And they have questions about, is that dependent on every different processor and cooperative, what that means? Or could you just talk a little bit about that situation? I know there seems to be some concern, some hard feelings in the countryside about those low prices that were locked in, and now we're seeing record prices on the other end. And it's really put some farmers in a bind, both financially and emotionally.
Yes, I've spoken with a few of the producers that I think you're talking about, Dan. And I think this was a hard lesson learned under this, but I've told some folks that this is a little like never having seen or read about or have anyone tell you how to use a chainsaw safely, and having somebody give you this tool. It can be a very effective, useful tool, risk management is, but if you don't use it carefully and safely, it can bite you too. Mm-hmm. And I think that in most cases, this is what happened. Many of the people, it was the first time they've ever done any form of risk management. And this was forward contracting, where you are obligated to receive that price and to deliver that quantity of milk. This was at a relatively low price, actually a very low price that it was locked in for. At the time, it looked like prices might have plunged even further. So it could have been a protection against possibly declining prices. But if I have an opportunity to work with producers, I tell them, in thinking about risk management, never lock in a price that's under your costs of production. Okay, you need to understand your costs of production, because if you do that, you've now guaranteed yourself a loss. And as we see, prices go up, they go down in unexpected kind of ways. There's a chance that those prices may go up and you're, be paid better than you had expected to get. So don't lock those prices in. That doesn't mean you couldn't put a floor under those prices. In other words, stop it from being able to go any lower than that for you, but give yourself upside potential. You can do that below your costs of production, as long as you're covering at least your variable costs of production. Okay. And that's one of the things that may be a pretty hard lesson learned here this time around. You might have felt like it was a brilliant thing to do if milk prices had dropped to, say, $10 or $12 a hundredweight. You've been getting paid more than market prices, but now, it doesn't look so good. So take the lesson. But don't say, I'm done with risk management forever. Just understand what you're doing and do it thoughtfully. It's never about getting a better price than you would have gotten consistently. It's about taking the valleys out, and you're going to give up some of those peaks. It's about getting a price you know you can live at.
Mhm. This might be a related question, but could you talk a little bit about interest rates? So is this an opportunity for farmers to restructure their debt at a lower interest rate, even, move away from locked in rates if there's no prepayment penalty and renegotiate interest rates at this time?
Yeah, I think that we are likely to have these close to zero Fed interest rates for a long time to come. The Fed is not going to, want to do anything that would squelch, an economy that's beginning to crawl out of here. They're going to watch a couple of different things. They're going to be watching employment levels. That's got to come back up a lot. They're really going to be keeping their eye on inflation, which I don't think we're seeing anything in the way of excessive inflation right now. We're seeing some rising prices due to shortages of a few products, but not really what I would call inflation yet. And we've got to see an economy that's really tugging at the bit and ready to go. I don't think we've got that. So yes, if you've got some, higher interest loans that you could move over into a low interest locked rate, especially if they're long-term loans, it would be a good thing to do.
Okay. Do we have any other questions from our viewers today? If not, I'm going to thank Dr. Stephenson for the very informative conversation. Thank you so much, not only for being with us today, Mark, but thank you for everything you do for the dairy industry in Wisconsin and around the country. We're honored to have you here in Wisconsin, and Cooperative Network considers you a great friend and colleague. So thank you for being with us.
Hey, Dan, this is Michael in the background here. We have someone that has raised their hand, Gary Ekoff, and we are going to allow him to talk here.
Excellent.
Hi, Gary, go ahead. Looks like his mic is muted.
Yeah, he's on mute, Michael.
Yeah, I'm trying to unmute him. There we go.
We okay?
There we go.
Yes.
What would you say in your experience would be the only way for a 200 cow dairy herd to survive today? Efficiency?
Well, you're not going to be able to afford to be a high cost producer, I don't think. If you are going to be higher than average, then you've got to receive a higher than average milk price, which means that your milk has to be special. It has to be definable in some way. We've seen organic as one way that's been successfully defining higher milk prices for producers for quite a period of time. We have seen, grass-fed as an identifiable characteristic. There are some plants looking for other characteristics. I don't know if this is going to be a long-term viable one, or if it's more of a shorter term, kind of a fad, but A2 is something that is a possibility. And then we also have some plants who have customers that just want to assure the conditions under which milk is produced. In other words, they want it to be from smaller farms. They want to know that the animals are well treated and cared for, and they've looked for volume of milk from farms that meet a handful of conditions like that, and they're paying a significant premium for it. So there are some opportunities, Gary. If you're going to do that, then you're going to have higher costs associated with it, but the higher price may be more than enough to offset those costs. I'm not disillusioned about how difficult it's been for a lot of farms, but we do find farms at all herd sizes that are profitable in almost any year. Certainly not everybody, but there are some herds that are finding ways to do that.
Okay, thanks.
Sure.
And then we have one question in the Q&A there.
Could I give a very brief overview and opinion of what the future of livestock and commodities look like? Ooh, yeah, I could get out over the tips of my skis real quickly, when I start talking outside of dairy. I feel pretty comfortable in dairy, but when I start to talk about wax eloquent about soybeans and corn and pigs and other things, no, I'm pretty casual reader of that information. I'm not well informed. So, I'm going to take a pass on that one. That's another speaker for you, Dan. You'll have to get that person.
Thank you, and I understand. Michael, do we have any other questions?
Nope, I think we've gotten everybody.
Okay. Well, please, I invite everyone to visit our website at cooperativenetwork.coop for the latest information on COVID or our members or the ag economy, whatever issues that pertain to you, please visit that, and also keep an eye out for our future webinars. Thank you again to Dr. Stephenson. Great to see you. Great to have all of you with us today. Thank you all, and stay well, stay healthy, and stay in touch. Thank you.
Thanks.